Hey everyone, it's Wolfgang. I want to talk about the danger of leverage in real estate investing, in taking out loans. Many landlords and syndicators in the 2019-2021 timeframe decided to grow their holdings and buy more properties by taking out short-term adjustable rate loans. Some of these were 3 years in duration. Taking out loans at that time, interest rates had historically been low for 10 years. If you go back many decades, there was never a time where for that long a period, 10 years, that interest rates had stayed that low. In fact, they were down close to zero at this time. In this time frame, syndicators and landlords taking out loans were used to, for 10 years, they had gotten used to the very affordable interest rates. So many people recognized that interest rates would have to start going back up at some point. It's been 10 years. The interest rate cycle is long overdue, and those people were cautious about taking on new debt that had an adjustable rate, a floating interest rate, and short term. People who knew that interest rates had been low for an extremely long time were much more cautious about taking out loans, the type of loans that they took out. Many people ignored it. Many people ignored the fact that interest rates had been historically very low for a long time and took out short-term adjustable rate loans, some as short as 3 years in duration. So starting in 2022, interest rates started shooting up. The Fed started raising interest rates. And the interest rate increase, interest rates rose from near zero to about 5%, a little over 5, I think it was 5.45% was the highest Fed rate. And it went from 0 to 5.45 very quickly. And if you can imagine, if you took out a short-term adjustable rate loan in 2019 or in this time frame, and you obviously needed to refinance it, you were looking at, instead of zero interest rates, you were looking at over 5% Fed rates. And of course, the loans you would take out would be higher than the Fed rate of 5.45. But when syndicators and landlords went to refinance their properties, they ran into this problem, the debt service coverage ratio. Taking out a new loan with a new interest rate, much higher interest rate, the debt service coverage ratio stood in their way of doing that. And here's why. The debt service coverage ratio, the DSCR, is the net operating income of their property divided by their loan payments. So in other words, a loan taken out in this time frame, their loan payments were low relative to what happened in 2022 and after. Loans taken out at this time, the loan payments were low. So the net operating income of the property divided by those low loan payments easily satisfied, generally, the 1.25 income to loan payment ratio. The typical DSCR that a lender wants is at least 1.25. That means the income is 1.25 more than the annual loan payments. So a DSCR of 1.25, 1.5, 1.75, that's what lenders want. Lenders do not want a debt service coverage ratio below that. Anything below 1.25, and you're going to have trouble getting that loan. So the problem was, there were two problems. One, they had to refinance those loans. They were short-term adjustable rate loans. And two, rents did not shoot up like interest rates did. Interest rates spiked tremendously in a very short period of time starting in 2022. Rents did not. So it became impossible to get the 1.25 debt service coverage ratio. If you look at this, the net operating income rose a bit, but nothing like the denominator, the loan payments. So syndicators and landlords refinancing their short-term loans, the debt service coverage ratio of 1.25 was no longer possible. So here's an example. Obviously, with the spike in interest rates, the debt payments on the refinance loan would be higher. So here's an example. An original loan taken out in 2019 to 2021 timeframe, a short-term adjustable rate loan. This example uses a net operating income of $500,000 for an apartment complex, divided by the loan payments, the annual loan payments, and these are all annual numbers. This is $500,000 annual net profit. This is $350,000 in annual loan payments. That's 1.42. This was the original loan taken out in 2019 to 2021. 1.42 exceeds 1.25. So no problem, we're fine. Okay, but the new loan with the much higher interest rates, we're going to assume that in the very short period of time that interest rates spiked, that the 500,000 really didn't change that much. The loan payments spiked tremendously because of the increase in interest rates. So if you look at the net operating income divided by the new much higher loan payments, this is a debt service coverage ratio of 1.05. That's not going to work. You will not get that loan. So here are syndicators and landlords. They must refinance that loan, but they can't get the loan because they fail the debt service coverage ratio. So what were the options? What are the, because this is still going on, what are the options for landlords and syndicators as their old loans mature and they have to refinance? They can give the property back to the bank. Many have done that. They can try to get a workout, what's called a workout with the bank, to get more favorable loan refinance terms. From what I've seen, that's kind of rare. That's not really happening that much. The other option is to put more money into the deal so that the loan they have to take out is less. In other words, they would end up with debt payments lower than this if they contributed more cash to the loan so that they would not have to get as high of a loan. But the problem with adding money to an existing deal for syndicators and landlords, anyone who used an outside investor to come up with the money to initiate that deal, to buy the property, it's almost impossible to go back to those same investors and say you need to contribute more money. It's one thing to raise money for a new project. Going back to the same investors and requesting more money for the exact same project because of the I consider this questionable behavior, that these people failed to account for the interest rate cycle, that the interest rates had been low for 10 years. They had to go up at some point. I think that was a mistake on their part. And their investors probably saw it that way too and did not want to contribute. So a lot of these properties went back to the bank. So what's the moral to the story? The first thing you can do is, number one, be aware of the interest rate cycle. They've been low for 10 years. Pay attention. Look back in history. If you look this up online, you will not find a 10-year period of zero interest rates in very recent, in somewhat recent history, going back 60 plus years. The first moral of the story: pay attention to the interest rate cycle. Where are we in that process? And then the other thing is, when you take out a loan, take that into account. Do not put yourself in a position where you've got an adjustable rate loan or an adjustable rate loan that matures in 3 years. Generally, at the end of a interest rate cycle, when you know interest rates have to go up at some point, an option is to use less leverage in your deals. At the end of an interest rate cycle, when interest rates are about to go up, you can initiate deals, bigger down payment, basically, less leverage on the deal. And that way, if interest rates go against you, you have a cushion in your operating. And that way, your net operating income divided by the new debt payments, it's not going to be as hard because you don't need as big of a loan to refinance if that comes up. So, and the other thing is, I question taking out short-term adjustable rate loans, 3-year loans, because you want to take advantage of some deal with adjustable rate for 3 years. You know, you're just asking for it. And all the people you get to invest in those deals, you're putting them at risk. And the likelihood that that's going to pan out with very high leverage, and then with the impending adjustable rate, the nature of the loan being an adjustable rate within a short period of time, you really want to think that through, because your professional reputation kind of depends on you making good decisions. So if you're curious as to why there have been a lot of large apartment complexes going back to the bank, this is why. It's because some syndicators and landlords took out short-term loans, some of them adjustable rate loans. They had to refinance. They were looking at very unfavorable, newly changed interest rates that forced them to try to raise money from their existing investors. That almost never works. Investors are not enthusiastic to throw more money into a deal whose outcome they thought was already certain. If you have any questions about this, you can ask in the comments and I'll try to get to them. But the bottom line is, it's like buying stock on margin in a stock brokerage account. How many of us buy stocks on margin continually? There's a small percentage of people, traders, who tend to do that. But there's a danger to it, because what happens? when things go against you, in this case, the interest rate's going up, the real owner of the property shows up, and it wasn't you. It was the lender. All this time you thought you owned that property, you didn't. The lender can take it away from you. The real owner shows up if you take out too much leverage and conditions go against you. So it's worth keeping that in mind. I mean, people have argued, okay, if I use less leverage, then there's a lower return on the deal. That can be true, and you may not be able to attract the same type of investors, but you're much better off with patient money anyways. If you only attract investors who want a large return in a short period of time and like taking a lot of risks, that can affect your reputation in business if it goes against you. So it's worth considering, and I hope this helps someone, and it explains what's been going on with all the large foreclosures. Thank you very much for watching, and have a great day.